Yesterday, I managed to take this insane 1 to 10 RR demand setup. Here's some proof if you don't believe me. And in this video, I'm going to be giving a full explanation on how to hit ridiculous risk to rewards using this insane new supply and demand strategy, and how it implements liquidity concepts to make trades go absolutely insane off your zones. So firstly, I'll quickly go over the basis of the strategy for those who don't know. So I have a supply example right here. Of course, I'll also show demand setups. But basically, what we're looking for liquidity supply and demand setups to occur is a push down, creating a supply zone. I'll get into how we mark up a supply zone soon. But then what we need to see is a small retracement that doesn't quite tap our zone before we then push down again. Now it is important that we break the low that made the liquidity. So in this case, this is the low that we broke to make this trade valid. And alongside this just being a minor swing to create liquidity, we've also created another supply zone. So we are now left with two supply zones. Now, of course, we can expect price to eventually come up to our normal supply zone, which of course, normal supply and demand traders will be entering here. A lot of the time we'll see a good rejection or a fake out, but we'll see it even give break of candle entry, come down a little bit, and then come up to our zones. And this just gives even more confidence that people are entering. And then prices use those people as liquidity to then come up to our zones. And from there, we win. And once again, these always hit insane risk to rewards. Right here, just to the low, this is a 1 to 6, that is just insane. Now, of course, I'll show lots of examples in this video, but I'm sure if you've ever traded normal supply and demand, you will have had it where you get stopped out by a couple pips and then price goes in your direction. And that is because our zones are the real zones that investors want to buy from. This is because, once again, on the supply example, we are right at the top of the move. And of course, this gives them a better price. This also allows them and us to catch a lot more of the move compared to normal supply and demand traders, as we are catching the entire move from the top to the bottom, whereas normal supply and demand traders might have a zone around here, marking out this, to have price come up to here, catch their 1 to 1, maybe a 1 to 2 if they're lucky, and then price go back. On top of this, you'll very frequently see insane momentum come from our zones like this, and that's because this strategy fills in all the requirements necessary for price to really want to go in our direction, and that's partially because we've already had liquidity being taken before we enter our zones. So markets will frequently just completely flip when they reach our zones. And yeah, that's about it for the basis of the strategy. But before I get into any of the rules that we always need to see before entering setups, I need to explain the importance of how we draw out our supply and demand zones. So we'll quickly go through that first. So for most cases, we actually draw our supply and demand zones completely normally. If you don't know what I mean by that, I just mean we wait for a big push up on a demand example, of course, and then we mark out the bearish candle before the move, as well as if the wick on the next candle goes lower. I'm sure most of you have seen this before. I did a video a while back for how to draw them for normal supply and demand, but that video is kind of outdated for this strategy. But once again, in this situation here, we'll draw out normally, just like that, and once again for here. And then supply example, once again here, we'll draw out normally. However, in certain situations, we will mark out our zones differently, and I'll show you that now. Now, I have to shout out RD Concepts for this once again. This diagram and actually the whole strategy was created and perfected by him, so show him some love in the comments because he's honestly goated. But as you can see on the supply example, we have the green candle, aka the supply zone, that has a wick that goes below the next candle. And in this situation, as you can see, we will draw it up only by the body and top wick, and we will ignore the bottom wick completely. We do this because obviously the selling started from the bottom of this close. Of course, this is where the bearish move started. So why would investors want to start selling down here at a worse price when they could just wait for it to come back to the real start of the move and start selling from here to get more pips, a better price, and just a bigger move? And you'll learn later about some strict rules that we have with this strategy, one of them being that candles cannot close inside our zones, which makes these accuracy zones even more important for us, as price could come to these zones, close inside the correct drawing, make it invalid, and then respect the correct drawing, still giving us a trade. Now let me go over some examples of this. So firstly, I'm going to show you the supply setup. This is an example of drawing up the zones normally. As you can see, we created liquidity here, as well as a supply zone to fake out. Right here, we can see the candle that created the supply zone never went below the next bearish candle, so we draw up the zone normally. And now here is a good example of using accuracy zones. As you can see, the wick of the bullish candle that created the supply zone has a wick that goes below the next bearish candle. And for this trade, it was very important that you mark this up by the accuracy zone, as if we marked it up like this, as you can see, we'd have closed in the zone and this would have been an invalid trade for us. However, when you mark it up like this, we tap the zone, got an instant rejection because this is really where the investors are trying to sell from. You'll see that a lot where you just get massive momentum boosts from our zones because they're just very powerful. Entry on the bearish close, I'll talk about that later, of course. And this was just a very clean trade. You could have taken this up for a max TP of 1 to 10 or even further, but I've got a max TP of 1 to 10. But this is a great example of when accuracy zones are very important, because if you draw it up normally, you would have missed this 1 to 8 trade. But now I'll show you a few examples of some demands just to make sure it's really in your head. So once again, right here, I have an example of a normal demand zone. As you can see, the bearish candle that created the demand zone never went above the next candle, and so we'd mark it up by the full bearish candle, target these highs, and you've got a 1 to 8 once again. But then for this trade, which is an insane trade by the way, as you can see, if we would have drawn it up normally, we would have closed inside the zone. I'm sure some people would have got in there, and then we would have even used them as liquidity. But luckily for us, we've got our accuracy zones, and we get an instant rejection, and from there, we hit an absolutely insane trade. This would have been a max TP at this high, but once you're at a 1 to 9.6, you're obviously going to go for a 1 to 10. So hopefully you somewhat understand how to draw accuracy zones now. There's more information on it and everything else I talk about in this video in the top link in the description. I'll also respond to every comment of questions that people have regarding the strategy. So please feel free to leave a comment, because trust me, I got you. Challenge me. But also, if you find this helpful, then you should like the video and subscribe. Pretty please. But yeah, anyway, let me get into some really important rules that we need to see before taking any setup using this strategy. And yeah, let me get into it. So these universal rules apply for all time frames, whether you're on the 5 minute, the 30 minute, or anything in between. You'll definitely want to abide by these rules every trade, no matter what. This is just part of the trading plan. And if you want to trade the strategy, then I definitely recommend you stick by these. So the first one I've already talked about, and that is that we are not allowed to close inside the zone. Because trust me, with this strategy, as you've seen on the examples, price always goes crazy away from these zones. So if it's closed inside the zone, then it likely wasn't a quality setup, or for some reason investors just aren't going on that zone. I've been trading this strategy for a while now, and it is very rare that I see candles close inside the zone and then still go crazy off it. So for example, right here, you can see the second it tapped the zone, it went crazy, rejected an insane amount. If this were to have closed inside the zone, then this would just not have been valid. It probably would have just continued going up slowly, but instead we've got this insane rejection. Now the second rule, this one might be a little bit more confusing at first, but you'll get to understand it. So liquidity must always take out its own high or low, depending if you're on a demand or supply. So in this case, on the supply setup, the liquidity was created, and it must take out the low that came up to create it, if that makes sense. So for example, on this trade, the low that we'd need to break before coming up to the zone to make this valid is right here. And as you can see, we did break that, and that made this a valid trade. Actually, I'll see another example right now. Obviously, this trade was invalid because it closed inside the zone. However, I see this right here. So let me just go into replay mode. So we came down, made this zone, came up after making this swing low, created the liquidity, and then the low that it would need to break for this to be valid is of course right here, which we did. It's okay if it is just a wick, it still counts as breaking the low. But yeah, that's very important for the strategy. And this one I feel like is quite obvious, but it's definitely worth mentioning because I've had people send me screenshots of zones that are already tapped, and I think it's just important to mention. So all zones just have to be untapped zones. Like I said, people send me screenshots of where the liquidity comes into the zone, comes down, and people think that's still valid. However, it is not allowed to touch the zone because that is counted as tapped. Now, if you're now getting confused about how I've marked out the supply zone, and you may think this is tapped right here, it's not tapped because this candle came down and closed bearish. So this is still part of the move that created the supply. If this closed bullish, then this would be an invalid zone and it would have been counted as tapped. But yeah, that's it for the universal rules that you want to be abiding to on all trades, no matter what time frame you're on, no matter what the setup is, how clean it looks in any other way. You need all three of those things every time. But yeah, that's all for that. Now let me get into some other important topics that we need to talk about. Alright, so as you can probably tell, it is a new day. I've just been spending time making sure this video is perfect and goes through all the topics you'll ever need to know regarding the strategy. The one topic that I'm not going to go through in this video is the 5 minute specific rules. However, if you want to see that, just let me know in the comments. Personally, I'm not trading the 5 minute anymore. The 30 minute just gives me way more consistent results, better results, and frees up a lot of time, and it's just way more convenient for me. However, this strategy does work really well on the 5 minute if you know the specific rules. So yeah, just let me know if you want to see that. But yeah, for now, I'm going to be going through all the 30 minute specific rules that you need in order to perfect the strategy. So yeah, let me get into it. So firstly, I get asked about trading times quite a lot. What session do I trade? How long am I trading for? So with the 30 minute charts, I'm trading all day, every day, which I know sounds long and doesn't sound time freeing, but I'm literally looking at the charts every hour or so for like 2 minutes. If there's a trade, then I'll take it, which as opposed to the 5 minute, where I was just sitting down for 5 hours per day looking for a setup, this is actually much more time freeing, but I'm trading all day, every day. However, there are definitely some trading times that I suggest you avoid. One of these being high impact red folder news. Obviously this includes CPI, NFP, etc. Sometimes it is okay to hold through some red folder news. It can often work in your favor. However, you also don't want to be taking trades as that's about to come out because you want to leave your stop loss some room. So those are some obvious ones that you just want to avoid. Then another time that you don't want to be trading is late Friday before swap hours. Just spreads will be high. It might not leave enough room to create a bottom wick on the next weekly candle. or a top wick. However, if it is a late Friday and you're really confident in a trade that you see and you're confident that it can blow up before the weekly candle closes and allow room for the next candle to create an upper or lower wick, then it can be okay to do. But that's it for trading times, and now I'll get into more specifics regarding the strategy. So yeah. Alright, so I wanted to talk about a few things here. The first one being something very important that I get asked a lot, and that is the max pip distance that liquidity can be from your zones. Now, as a general rule, I would suggest 30 pips is a good maximum from your zone, because any further than that, and it's not really liquidity for our strategy, it's more just like a low. So right here, as you can see, this zone was 3.7 pips away. This zone, 17. This one down here, also 17. And that's a fine amount of pips away. Obviously, ideally, it's closer a lot of the time. However, maximum 30 is a good way to tell. That's for my pairs at least. If you don't know, I trade GBP JPY, Chef JPY, USD JPY, and Euro USD. Euro USD is the one exception for this 30 pip rule. I would say more like 15, because 1 pip on EU looks like a much larger move. But yeah, that's something important that I get asked about a lot. But secondly, the reason I have all these zones marked out is because I want to talk about which zones you should and should not take. So as a general rule, I would suggest not taking the middle zones. Personally, these are the ones that I'm least likely to take. Of course, sometimes I will. If they give a really good rejection and the zone is looking nice, then there is a chance that I'll enter, potentially with lower risk. And that's because a lot of the time, price will either come to your first zone and just make a continuation pattern, just continue going up. However, if they break through this first zone, you can expect it to just be correcting the entire move on the left side. A lot of the time you may see a rejection because obviously people will get in at these zones. However, where people are really trying to get to is not this zone, because we're still right in the middle. They're trying to come all the way down to zones like these, which if you trade normal supply and demand, this may look a little bit weird because it's quite far away and this just looks like a major low. However, when you think about it, this right here is where the buying really started from. This is the start of the move. And of course, we have a nice zone here where a lot of people will get in. We'll use them as liquidity to make our zone go absolutely nuts. But of course, why would investors be getting in up here, for example, when they could be getting in down here for an extra 180 pips? It just doesn't really make sense. Obviously, the top zones can hit because it's just a continuation upwards. However, once we've broken that zone, we can expect it to be correcting the entire move. However, if we're still bullish, we're still following trend, then you can expect these zones to go absolutely crazy, because this is where everybody's going to be buying at. This is the lowest point. This is where the move started. This is where investors, institutions are going to be placing their orders. So yeah, now whilst I'm talking about the fact that it must follow trend, I feel like this is a good point to talk about that. A lot of people do constantly ask me how I identify trend. However, that could be a full video in itself. I'm not trying to be sat here for an extra 30 minutes. However, in the first link in the description, there is a Discord alongside RD, who is the creator of the strategy, so nobody knows it better than him. That is where I learned the strategy from, and honestly, I could recommend it to anybody. And there's weekly webinars in there going through trend, where we think price is going to go. There's also daily forecasts, so every morning there'll be topics on where price is likely to go, what we think trend is looking like, valid zones for us, zones we're not willing to take, etc. So I'd definitely recommend that, but I'll go through like a basic explanation of some of it. So a lot of it is just related to higher highs and lower lows. For example, right here, you can consider that price is bullish. We've had a massive bullish reaction. We're breaking higher highs, making new highs constantly. And if you look to the left, we are not breaking lows. We have 3 in a row here where we just never broke them. And these are definitely majors. Even just these little areas down here where we first started it, we weren't breaking these lows. So we can expect to continue bullish in a situation like this, even though we're coming from this massive downwards push. And also something equally important is just looking left. So moving up to what, the 4 hour, we can see we are bullish on this higher time frame. And where are we reacting from? This area down here. This is a perfect area for us to continue bullish from. And you can see here, there's a high chance that we would come down here, fill in all these gaps and continue up. This just looks like a perfect place to me to go bullish. But that's just a very surface level explanation of how to identify trend. Higher highs, lower lows, looking left, obvious spots that price could go bearish or bullish from, whether that's matching highs, matching lows. And it's also pretty important that you do go onto higher time frames a lot of the time for this, especially when you're on the 30 minute, because trend does matter a lot. But yeah, if you're trying to learn more about that or just anything about the strategy, I do recommend the link in the description because it's what helped me get good at the strategy. But yeah, let me get on to the next topic, man. So another very important topic that I haven't talked about yet is our entry model. Obviously this is very important because if not, you're just gonna be getting in at every zone, and yeah, that's not the way to do it. So what we're looking for before entering trades is the first candle close in our direction after tapping a zone. So for example, in this setup here, I think I showed this earlier, we tap this zone, we wouldn't enter until we have closed bullish. So right here, this is the first bullish close after tapping the zone, and this is actually a very nice entry. This is nothing to complain about at all. However, it is also okay if the first candle that taps the zone is the one that closes bullish. For example here, we have a candle, came into our zone, went bullish, This would be our entry, and you could take this up to what, this high maybe, and that is an absolutely beautiful trade right there. It's a very simple entry model, but it's very effective. Now on occasion, we will use other entry models, such as candle flips or break of candle. Break of candle entry can happen when a candle hasn't closed bullish yet, on a demand example of course. However, the trade is going up with a lot of momentum, and you're trying not to get left behind. Break of candle entry can be good in those situations. However, 90% of the time, it is just the bullish close. I also wouldn't always get in on break of candle entry because of that, but sometimes it is protocol. And I'll quickly try and find an example of when flip entry would be used. Okay, this isn't the best example because this candle never tapped. However, imagine this black candle right here did tap the zone and then came up, closed outside, and then this bullish candle came down, made a bottom wick, and then flipped within the last like 10 minutes of the candle, then that is valid for a flip entry. And as you can see in a situation like this, that would make a massive difference, because if you aim for these highs, you're getting a 1 to 10, as opposed to if you got in a normal entry, you get a 1 to 3. Now that may sound quite confusing, so please feel free to comment any questions, because I don't know how good that explanation was, but sometimes flip entry can be the move and it's valid to use in a lot of situations, and it's pretty important to know. I just don't know how to explain it very well, and I can't really find a good example. Alright, so now I'm going to be going through take profits and where you want to have them. So always, minimum risk to reward is 1 to 3. So for on this trade, a 1 to 3 would literally be here. However, a lot of the time, you'll notice, you realize you can go a lot further than that. So the majority of the time, TP1 will be at highs, just whatever the closest high is. So in this case, this would be a 1 to 6, and that is just the case for most of the time. However, if you're interested in getting even higher risk rewards than these, there are multiple ways you can do this with TP2s. So a lot of the time, you want to take partials at TP1, maybe take half of your position. Sometimes TP1s may be a full 1 to 10. I had it happen the other day with that 1 to 10. That was just a full 1 to 10 because momentum was coming crazy, so I just ran with it. But TP2s are valid through a lot of ways. For example, the Fibonacci retracement tool. If you mark up the bottom of the move, up to the top, down to where it tapped, you can get a decent range of where price is expected to be able to go up to with like fair ease. So a lot of the time you can extend it to this one level, but for actually what, 0.2 RR, but that's still TP1. However, if you want to hit TP2s, I'd recommend you put the level of 1.618. This is the one I've got ticked. But you can extend TPs to here. For example, on this trade, this would have been a max 1 to 10 if you took it up to TP2, and it would have been pretty easy as well. That's just one way that you can determine TP2s. Of course, a lot of the time, there'll be maybe highs around here, and it'll come down, come to your zone, and you can just target those highs for a TP2, and then this being TP1. Or if there's just a massive push down from, say, news, and it comes to your zone, and it just looks like it wants to correct it, you could easily take your TP up for a max 1 to 10. That's just another way to determine TP2s. A lot of the time, if there's big moves to correct, I will rarely go for just a 1 to 3. I'll extend that TP to hopefully 1 to 5 or higher. And yeah, that's how you can really maximize your TPs for the highest risk rewards possible. Now I want to talk about max stop losses. This is something that will rarely happen. However, it's still important to talk about. So this trade right here, as you can see, we use an accuracy zone. If not, this trade would be invalid. But because this candle goes above the next bullish one, we mark it up just by the body. And you can see we tapped and it gave a horrible entry, okay? In these situations, if you got in just on the candle close, let's just pretend this was a bullish candle, you put the stop below the wick as per usual. For a 1 to 3, you would be looking at all the way up here, which is 150 pips for a 1 to 3. You don't really want to be doing that. So instead, in these situations, what you'll do is give it a max stop loss of 30 pips, because if it has to do that, then it obviously means there was an insane reaction from the zone, so it likely won't be coming back anyway. And of course, you'll get a better risk to reward, and a lot of the time you won't be able to secure a 1 to 3 if your stop loss is 50 pips. In comparison to this, where obviously in this situation you would be going for a max 1 to 3 because it's still 90 pips, you would have hit TP. So that's just something that happens rarely, but when it does happen, you can easily get a nice win just by having this max stop loss rule. And yeah, that's about it for that. Finally, I want to talk about when you put your stop to break even. I know putting stop to break even makes a lot of people more comfortable, which is completely fair. However, I don't until TP1 has been hit. I like giving my trade breathing room because a lot of the time it will retrace back down, tap the zone again because these zones are just insanely strong, and they will just retest, hit off it again and win. So I don't like put my stop to break even until TP1 has been hit, because by that point the trade has basically already won, so there's no reason to take a loss on it. The only other situation is if it got really close to TP and then just reversed on you, but that's one of the only other situations. Other than that, red folder news a lot of the time can just blast through your stop loss, so you might want to be break even because you might get slippage anyway, so it's just safer to do it that way in my opinion. But yeah, there's not really many times I'll put my stop to break even other than those. And yeah, that's about it for the 30-minute rules. Now I'll just go through a bunch of examples so you guys can really get this all in your head. But yeah, anyway, I'll see you in a second. Alright, so I think this could be really helpful for a lot of people. I'm basically just going to backtest through this and show you my thought process of what I'd be thinking during these trades. Now, I do know the results of these, I'm not going to sit here and lie to you, but I just want to show you why I'd take trades, why I wouldn't take trades, etc. So what we have here is a clear downtrend by what it looks like. You'll definitely be looking to take sells if you're just looking here. However, if you look back, for example, let's go into the 4 hour. This looks like a perfect place to retrace from, in my opinion. Maybe to come down a little bit more. However, we gave an insane rejection right here, which if we go into, say, the 1 hour, we can see right here, bounce perfectly off this demand area. And this looks like a good place where you could go bullish from. It's honestly such a useful skill to be able to tell where price will go bullish or bearish from, or at least to have a good guess of it, because a lot of the time that's where you can get some insane risk rewards, because we have this entire move to correct, especially when we are clearly bullish on the higher time frames. And this is just a perfect place to go up from. So moving back to the 30-minute, we'll go forward a bit. Demands are on the table. However, supplies could be if we break this low right here. Now we can see we have actually created a setup right here. Actually, wait, let me mark this up correctly. Accuracy zone, because this wick went above the next one. Is this valid? This is also valid right here. So either of these zones could be valid to take. Doesn't really look like there's any supply opportunities here. So we'll just continue, see if any of these tap the demands, which they do. I don't know if either of these zones win. I just remember there's something around here that does win. It might not even be one of these, but that is a gorgeous candle. So this is actually a great example of when we're getting a break of candle, because we broke candle before closing bullish. And in this situation, it gave us a slightly better entry. So entry would be there. Stop will be very tight because we are quite far, and 16 pips is about equal to 30 pips on the other pairs. So we can have that very tight. We don't really expect it to come back. And TP areas, this isn't even a 1 to 3 at the high. So 1 to 3. So for TP1, this high right here isn't even a 1 to 3. So we can look back, see where a good area would be. For example, right here maybe, or right here. Let's say around here. And then honestly, TP2 could actually be pretty high, because we do expect this to retrace a lot if this does go bullish. Either this loses, or we expect it to go very high. So TP2 could be around here. And let's see what happens. As you can see, this is why we don't move stop to break even prematurely. It will often play around the entry area. A lot of the time retest the zones. However, this is just low volume. So when volume picks up, I'm sure this will probably do something nice. Okay, that's looking like a news candle, but it still works in our favor. And play around a little bit, and that's TP2 here. Of course, this was highly assisted by news. I'll show another example where this didn't happen because I actually forgot about that. But this is just a great example of where you can predict price to go bullish from an area where we look bearish, as well as just a nice zone, a nice entry with some good targets. But I'll see if we can find another one. So we have created another zone here. Let's see if we actually come back to these. I actually don't know about these ones now. That was the only example I had marked out, but guess we're just backtesting now. Will we get a rejection from this zone? We do. Will we close bullish? That is a close on the edge. I won't count that. And we do close bullish. When a candle closes on the edge like this, I don't fully just neglect it, because we are still right there. So if we get a massive bullish reaction like this, then I'm still chill with it. However, if it was like a slight bullish reaction, then I would consider it invalid. But because of this candle, once again, this would be break of candle entry, but I'll be conservative and say we got in at the candle close just because of how this closed on the edge. And we can say TP1 probably here. That's a very good area. And for TP2, we can just aim for these highs for a max 1 to 10. Let's just extend it a little bit just to go for the 1 to 10, because you might as well at that point. As you can see, we are clearly going with trend. This is a good spot to go from. Only reason not to is because we'd want to fill in this area down here. However, let's see how it goes. Yes, I just appeared out of nowhere. Okay, this might just lose, but this could just be a good example of it retesting the zone. Okay, that's just a good example of retesting the zone, because these zones are very strong. They'll frequently do that. God, I've got to extend this TP. This might be a long one. That's another thing with this strategy. You do have to be patient, because obviously this is a 30-minute chart. A lot of times trades will take a while to hit TP, but for me, that's the nicest thing in the world, being able to wake up to TP being hit, which, as I say that, TP1 hit on here. Let's see if TP2 can get hit, potentially, the full 1 to 10. Ooh, maybe not, to be fair. But stop is at break even now. So this is a no risk trade. We've already locked in half profits at the TP1. And to be honest, I actually still do have faith in this continuing up, because this is just a bullish trend. And this is looking good. And TP is hit. To be fair, that is an absolutely beautiful trade. Of course, you won't be hitting them every day. that is a full 1 to 10. And on top of that, this is a very long trade to wait through. I've never had to wait 4 days through a trade. Most I've ever had to wait is about a day and a half. This is rare, but it's something that I'll have to deal with at some point if I want to hit these 1 to 10s. Now, I don't think I even explained this, but this setup was valid because of the liquidity right here. We also faked out this demand zone right here. I'm guessing in the live markets, we probably got some rejections, made this upper wick, faked out some people, took the liquidity, came down to our zone and then won off that. But before I end the video, I might as well end with what I started with, which is how I caught this insane 1 to 10 trade on CJ. Now this is a clear uptrend. We can see that we are just trending upwards. This isn't really a place that we'd reverse from. We're looking literally in the middle of this gap. We can look to at least fill this in maybe before going down. However, on the higher time frames, we're bullish anyway, so I'd be very confident in this trade. But back to the 30-minute, this is just very clean, to be honest. We had our zone marked out normally. We had our liquidity, as I've already marked out. And originally, I was just targeting these highs for a 1 to 7, I believe, right here. However, when I saw us coming out with this momentum, which is actually insane, by the way, this strategy is ridiculous, I did move my TP to 1 to 10. No, this was not news at 3 AM. There may have been some addition of conflict going on somewhere that helped this trade out. However, I'm pretty confident this would have won either way. But we got a very nice entry on this. It should have been on the bullish close, but I got in a little late when it retraced a tiny bit, so I actually got an even better entry. So that's why it's there. Even if I did get the normal entry though, this would have hit 1 to 10. But this was genuinely an insane trade. To be able to hit a 1 to 10 in 3 hours is ridiculous. I'm so grateful that I found this strategy. Once again, shout out RD. His Discord is in the link in the description. It's what helped me get so good with the strategy so quickly. And yeah, man, that's about it for the video. I don't really have much else to say. Please like if this helped you in any way. Please subscribe and follow the Instagram. And I'll see you next video. I hope you have a wonderful day or night, wherever you are. Peace.